Yes, thanks, Deepak bhai. And yes, it's a pleasure to be part of this panel with the three authors of the publication, Rutvik, Kartik, and Mahesh. And rightly said so that it being at a very short notice, and this being the last week for filing of tax returns, and the amount of media coverage this time this topic has taken, I think it has been hardly been so much in news in last decade, as rightly mentioned by Chirag. Though it's been there for last decade. Now, why? And rightly so, because the implications of disclosure being wrong or incorrect or non-disclosure are such, I would say, dangerous, I would say, that one needs to be aware how to file it, how to correctly fill it. Let me share my screen of what we are going to cover or what the panelist is going to cover. Before I hand over to them on different, I ask them different questions. And so, Friends, of course, it's a rainy evening, at least in Mumbai, and it's been, I think, raining across the India. And but being the last week and the importance of this topic, I think is that's why we have such a huge response to this webinar, or I would say panel discussion through virtual mode. Now, of course, the foreign assets and incomes have been a hotly debated topic, but its importance of reporting is very much so, and a gray area also, because today, at least for the Indian domestic income and assets, or I would say the Indian income which you accrue from various sources, have largely been reported by third parties, and it has been, you can easily capture through downloading 26 AIS, AIS, TIS. Unfortunately, or I would say fortunately, because sometimes the data transfer, whether it's correct or not, we don't have such sharing of data between countries. There are automatic exchange treaties, and the data has been shared, but it's not like in the form of like we have AIS and TIS, like even in the case of CBCR, which is now capturing data of related party transactions in case of multinationals. Hence, it becomes very, very important, and the implications of non-disclosure are very dangerous, even whether it is because of oversight or is being too old, dormant accounts where you are not contributed and you have become the owner of the asset. The income might be very minuscule. How to be reported? The schedule itself has A to G, and there are even four parts of A, the part A schedule of Schedule FA. So I think these are some of the very tricky areas where there will even be whether you need to report in two places, whether you need to report at one place. What is the history of this? So I think for that, before I spend any more time, let's jump into the objectives of why this has been in place. And for that, I will request Ludwig to share his thoughts and of these objectives of this foreign asset reporting and income report.
Yeah, thank you, Hardik, and many thanks to BCAS and the Direct Taxation Committee for both these opportunities, the opportunity to allow us to write a book on this topic, and for today's panel discussion. This was a need which was felt rightly by the committee that there are several queries on these Schedule FA. And I don't know what it tells of our tax compliance and the guidance on tax compliance when one pager Schedule FA can result into a book and then a panel discussion where probably 700 people are interested to hear it. So I think a lot has to be said for the guidance which is required on this topic, and quite important because we are today, and I believe so that what President Chirag said, what Hardik you also mentioned, it's 10 years since this requirement is there, but why today so much attention to it? I think today we have the benefit of experience. Over these years, what has happened is that they have got huge amount of information. I don't know which other country has got 14 foreign asset investigation units in their country. Here we have got 14 such units, so you can just imagine how much data they are getting. Based on that data, they are also not skipping in levying penalties, which are also, frankly speaking, uh, in many cases, quite harsh as compared to what the requirement is. But all being said and done, this is where we have come to a confluence where many people have invested overseas, many people have foreign assets. those assets are in many cases mistakenly not reported, or they are incorrectly reported, insufficiently reported. And therefore, today we have got a case where scores of notices have been issued, and therefore we have these, penalties. And now today, thankfully, we have got certain judicial precedents also on this issue. So all this Karthik will also be taking in detail. But I think so today, therefore, this topic has gained such a lot of importance, and we have at a right time probably, BCA in its foresight as always has come out with at the right time for its publication and today's panel discussion. So we hope to cover as many issues as we can in this, in today's panel. But before we go into these questions, as Hardik rightly said, it's good to know the overall objective of this schedule. We all know there have been several cases of tax evasion, especially with these kind of investigative journalism. We know that they have been there in the front pages of papers where well-known personalities have got foreign assets and which have not been declared for decades. Now that probably is the whole crux, and that probably is the whole reason why this schedule has been brought in. It is a tool to get to whether the person has done any tax evasion or not. Obviously, while the introduction happened in assessment year 12-13 onwards, but the whole steam and the substance of it came from AY 15-16 with the Black Money Act, and there being a penalty on it, because earlier to that there was no penalty, and therefore even if you did not disclose, there was no penalty on it. But what is the objective? So when you are filling up a Schedule FA, do consider that these are the two primary objectives for Schedule FA. The tax officer is going to ask you that what is the source of the funds for which the foreign asset that is disclosed by you. What is that source? Is that source from tax paid money? Is that source from money which you have correctly submitted to tax, even if tomorrow it is exempt, but have you disclosed it? Or if you have invested while you are a non-resident, then today, were you a non-resident when this investment was made? This is one of the primary objectives, obviously, of finding out, of requiring you to fill up this foreign asset schedule. And second is the taxability of income from such foreign assets. So if you have an asset, in most cases, there would have to be an income on such asset. So where is that income? Have you reported that income? Have you correctly reported? Have you? And in fact, after since quite last few years, they have very pinpointedly asked about where exactly is this income reported to tax. So all these are the two major objectives I feel which are sought to be met by this Schedule FA. And obviously, there have been questions where people tell us that, oh, this has never been disclosed, and people who actually try to evade tax. I don't think Schedule FA is meant for such people. The whole idea is that people who are consciously and honestly declaring their incomes to tax, probably they have got investments when they were non-residents, and now today they have become residents again, or they have used LRS and other routes to invest outside India. Those are the people who are benefited mostly by this kind of discussions, because they need to correctly disclose so that they don't get ensnared into a wrong or incorrect reporting and thereby facing a penalty. So I think this is where our objectives should be kept in mind, for what questions and what queries does the tax officer want to derive from this simple Schedule FA. Apart from that, I would feel that certain principles also need to be kept in mind. I have seen time and again when people are trying to match whatever they have disclosed in Schedule FA to their balance sheet. Please bear in mind, this is a disclosure schedule. And I think department has also in a couple of cases very clearly clarified that please look at the disclosure requirement. Don't go by the fact that, okay, does it tie in with my balance sheet or not? That is not the objective. The objective is that, okay, there is a lot of data which they are receiving from foreign countries, especially the country from where you have invested abroad, and that country will send some data. They want to match that data. So that should be the focus. Focus should not be that, okay, am I tying in with my balance sheet on so-and-so particular date or not? Apart from that, as I discussed just now, that matching from what perspective? So we have the automatic exchange of information, which is essentially an OECD framework on common reporting standards. We have the FATCA, which is an agreement which India has signed with USA. These and many other, in fact, even under the tax treaty network, also the department is getting a lot of data. And there are various sources from which data is shared to the income tax department. That is the objective which they want to match, because that data when they get, and if you have not reported that data similarly in the Schedule FA, there will be a mismatch, which will probably result in a case where they will ask further queries. So objective should be that as far as possible. Now, The fun part is that we don't know what data they have got. Obviously, because they want to target people who are evading tax, or people who are evading tax by not disclosing this foreign assets. Therefore, they are not sharing that data with us, and therefore it becomes probably, as we call it, shooting in the dark kind of game. So you are trying to probably estimate what kind of data will be shared, and that data you're trying to match it in Schedule F, and that is where a lot of mistakes can happen. This is where we will try to give some guidance wherever possible, that okay, what best way should be disclosed and what assets should be disclosed when and how. And finally, at the end of the day, please believe me that nothing from our experience or whatever limited experience we have in handling such cases where mistakes have happened, nothing moves without documentary evidence. Even today, India and the tax department in particular will not go by your word, your affidavit, nothing. They will only go by whether there is a document to prove that this so and so asset was purchased when you were a non-resident, or that this asset, the source of funds, you are able to trace and bring it back that yes, these are the assets which are held. Recently, when I was in discussions with a senior tax official, he clearly said that they have got 40 or even more years old cases which are not getting closed until the taxpayer is able to prove that such assets were held when he was a non-resident. Can you imagine? I don't know how many of us which literally have more than a decade old documents. Even if we have, how far have we kept them to show that enough, show them and take them, retrieve them and prove them? I am seeing many cases actually fail because of that. There are clients who come to us and tell us that, oh, what does it matter? I have given you income data. Why do you need to know more than that? It's not that we want to know, it's for their own safety. And therefore, clients should be warned that if not today, tomorrow or later, 3 or even 10 years down the line, when the officer will receive the data, he will send a notice asking you, where is this asset? Show it to me. At that stage, if you are not maintained, we have several cases where people say, no, that company has just gone closed down. We don't have that data. That bank has closed down. The bank has got merged. These are common instances which happen. And therefore, we now make it a rule that we're telling every client that please, on every foreign asset and every foreign income, please maintain the full documentation. Do not skip away, do not skimp away thinking that, and I'm sure most of you would have encountered where the client will come to you and tell you, oh, give me the Wi-Fi password, I will show you, where the data is stored on a cloud. Please don't go by that. We have had cases where the person was showing us a financial institution's data, his own ESOP data. And then next month when I told him, okay, send it to me, he said, oh, no, that financial institution, has closed down. The data is gone now. I'm not able to retrieve it. I don't see, how safe that will be, because this kind of having no documentation, I'm not sure how far, even with your own proof, with your kind of documentation, with kind of proof, banking statements, all that, finally the officer wants to look at that statement of the foreign asset which he wants. So please be careful that documentary evidence also becomes quite important. Hardik, back to you.
No, sorry,
Thanks.
Yeah, sorry, Kartik wants to make an
additional point. There could also be a possibility that at the time of filing return, you might have control over the data, but at the time of assessment, probably you might lose the control over the data. So it's better to keep it with you at the time of filing the return itself.
Yeah.
Thanks, and Kartik, for this, initial remarks over the objectives. In fact, I can draw two conclusions out of this. One is, where in doubt, please report. So at least you are, because see, as I told, initially, here the data is not being only captured from you. They are getting data from third sources. Also, this data is not available to you at the time of your filing of return. So there is nothing like that feedback, that this is not belonging to me. If they know that this is of your data, it is your responsibility to have a documentary evidence that no, this doesn't belong to me. In fact, I remember the old, instance where a person had gone for a hearing, for assets outside India, and he was asked to, give some proof, and it was a Mauritius entity, and he said, "I will come back to you in 7 days." And the officer called him in the evening. "I have got the data. You please come for the hearing tomorrow morning." So, something which you take, 7 days, they might get in, few hours. And it would be, not correct to say that, okay, how they will come to know, how they will be, able to trace this information. In fact, there are intergovernment agreements between countries where they share information very swift, and it might go beyond the number of years which you might be storing data with you. You might, and in fact, we all know under FEMA, for some transactions, even they ask documents or 25 years old, 30 years old, to prove that whether this transaction was yours or whether the asset was owned by you or whether the reporting was done. It is our responsibility to prove whether we have done it correctly. Now, after these objectives being set in, let's go with some, I would say, quick fire questions, and I will ask Kartik to answer those. They might seem very basic, but let me tell you, these are the genesis of how a schedule FA should be disclosed and might be applicable in most of the cases. So I do this quick, and I will ask questions to Kartik and would request his views. And if Rutvik and Mahesh can drop in comments, it would be more than helpful. So the first question is whether a non-resident or an RNOR need to disclose its assets in Schedule FA. Kartik.
Yeah, thank you, Hardik. So a non-resident or a not ordinary resident is not required to disclose for an asset in schedule. This comes very clearly from section 139, read with the rule, read with the forms and the instructions there too. So only a resident and ordinary resident needs to file a return. Please be mindful that now with the new definitions, 2 additional categories of residents have been included since last couple of years, but both of them automatically become NORs, and therefore there is no extra obligation of reporting of foreign assets on these 2 new classes of residents as well. So only a resident and ordinary resident is required to report foreign assets.
Absolutely. Now the second would be connecting to this. What if a person who has been always outside India automatically becomes resident, or comes to India and becomes a resident after 2? Generally, you have 2 years as RNOR. If you have been outside India, the first 2 years when you are in India, people file returns and they have been told that, okay, you don't have to report because of your RNOR. But then it should click to you that it is only in RNOR cases and not in ROR cases. And the third year you start reporting. Now, in such cases, what needs to be reported? Because under FEMA, you are allowed to keep everything outside India, which you have been, acquired. So whether each and every asset outside India, which he has generated from his sources outside India when he was a non-resident, what are the implications on such people?
Yeah, so the moment you turn resident and ordinary resident, the FA schedule kicks in and becomes applicable for you, and you have to disclose it. You have to disclose your foreign assets, irrespective of whether they are whenever they are acquired, and except for there is a small exclusion for a foreign citizen, which we'll cover, I think, in the next question.
You can cover, yeah.
But the moment you turn resident and ordinary resident, the FA schedule becomes applicable to you, and you have to start disclosing all foreign assets, irrespective of whenever acquired. I'll also try to cover a reverse situation where a resident who has already been disclosing foreign assets in its schedule and he turns a non-resident or an NOR in a particular year, then he can stop disclosing those assets the moment he turns non-resident or an NOR. Till the time he is resident and ordinary resident, he has to disclose all foreign assets that are acquired.
I think I'll just add one point here. There is no threshold for disclosure on Schedule FA. And there are certain queries where people come back telling us that no, up to 5 lakh rupees, bank account, we don't need to disclose. That is not the case. The case is that a penalty will not be levied in a case where a bank account or is not been disclosed, which has a balance of 5 lakh rupees. But that process has to be undergone. If you're not disclosed, they will trigger a query, a summons will come, then a notice will be issued. Finally, a penalty may not be levied, but you're still undergoing the whole process. So it is always mindful to be kept that yes, every kind of foreign asset has to be disclosed, whether small or big.
Yeah, that's correct. Yeah.
Correct. So I think that helps. We are already getting questions in Q&A box. So let me tell the participants, we'll try to cover them in the last 10 minutes. Let's first cover the questions which we already prepared, and most of them should be answered. Now, just to add on this, Kartik, whether minors needs to be disclosing their assets. And whether, because normally minors' income will be clubbed with the, person who is filing as a major with a guardian. So sure. What is your take on that?
Sure. So before I come to that, I'll just take up the earlier question on foreign citizen. There is a small point there. So like we said, all residents and ordinary residents need to make the disclosure. Correct. In case of a foreign citizen who has come to India and has turned resident and ordinary resident, 139(1) explanation and provisos, both provisos say that yes, you are liable to if you are liable to file a return if you are a beneficial owner of a foreign asset. Then you go to Rule 12. Rule 12 says you are not allowed to file ITR 1 if you have a foreign asset and foreign income. So yes, you are liable to file ITR 2 and not ITR 1. When you go to ITR 2, there is a foreign asset schedule, and that foreign asset schedule, at the bottom of the foreign schedule, there is a note which says in case of an individual not being an Indian citizen who is in India on a business, employment, or student visa, an asset acquired during any previous year in which he was a non-resident is not mandatory to be reported in this schedule if no income is derived from that asset during the current previous year. So this is a small exclusion for a foreign citizen who has turned resident and ordinary resident, and he does not have any income from a foreign asset which was acquired when he was a non-resident. He is not required to disclose that asset.
So I think this is the only case where citizenship comes into play. That if you are having Indian passport and if you become ROR, right, then you have to have Schedule FA. But if you have a foreign passport, even if you are ROR, and if you satisfy that condition, then you don't have to report that. I think this is where it comes. So Kartik, you can take on the minors thing also.
Yeah, correct. So in case of minor, again, a minor who is resident and ordinary resident and is owning a foreign asset, either legal owner or beneficial owner, he has to disclose that foreign asset in his tax returns. There could be a possibility or a case where the minor doesn't have any other income or doesn't have income from that foreign asset itself, or has an income which is actually clubbed into his parents' return. Even in that case, there might not be any income, but he still is technically liable to file a tax return as per 139 and disclose the foreign asset which he is owning. I'll request Rutvik to share a practical experience on what are the difficulties for a minor to actually file an online tax return.
Yeah, so we had a case where a minor had a bank account, and typically this is happening in cases of students who are going abroad for studies. They do not have their own incomes, and therefore they are as such not required to file their tax return. But the moment they have a foreign asset, and which will be simple like a foreign bank account, which is created just for the purpose of making payment of fees and their day-to-day expenses. Now, because there is a foreign bank account, the year in which they have left, they do not get the benefit of going outside for the purpose of employment. So they have actually crossed, or they would have crossed also 182 days in India because they leave only somewhere in October. So now problem happens is that for that particular year, they are a resident of India. They have a foreign bank account. They are otherwise not required to file return, but they are because of section 139, they are now required to disclose it. The issue is coming out practically from the point of view of filing the tax return. So we've encountered an issue where when the minors, we disclose a foreign asset and we tried to upload the tax return, it refused. And it said that unless the minor has an income which is earned by its own exercise of skill, only then they will be allowed to file the tax return. So this was very strange, and we reached out to the systems department and we asked them that what is this issue? And they said, no, you have to club the incomes anyways with the parents. So why are you required to file the tax return? And then I explained them that while you're right to say that, yes, there is no requirement to tax that income and club it into parents' hands, the same does not hold true for a foreign asset. But if you notice, there is a fourth, I'll just refer to it. There is a fifth proviso to section 139 where they have given certain limited exclusion for clubbing, but it is not very happily worded. So prima facie, if a minor's income is as such clubbed with the hands of one of the parents, the foreign asset may also be disclosed in that same parent's hands. That is what would be ideal. But if you notice that proviso, it says that it should not apply to an individual being a beneficiary of any asset located outside India where income, if any, arising from such asset is includable in the income of the person referred to in the earlier proviso. So in accordance with the provisions of this act. So they are trying to say that if the income is includable, then the person is excluded from disclosing here. In our view, practical view, we would say that better that a parent at least discloses that asset, even if they are not a signatory. Generally, they are a guardian. And in that role, their name is also there on the bank account. So probably it's better for that parent to also disclose the bank account so that tomorrow there is no issue. This was highlighted to the systems department that probably this will create an issue. And in fact, that resulted in issue, I think probably in early part of this year itself, there were scores of notices which were issued on minors. I'm not sure what action then finally happened on it, but I believe so that department itself realized that their minors could not file the return, then how will they disclose it? So that is where I believe so that steps would not have gone further on an adverse side. I think, but that's an important point that one should take note of.
So I think here is where, that becomes to very doubt you should report. So if a parent knows that minor has any asset and if they are as a nominee or as a guardian, then better to report in their return. So at least tomorrow, if you get a notice, you can always say that the reporting has been done. It's been just done here because there is an administrative, difficulty in the reporting. And this is, I think, a very live example. Thanks, Rutvik, for sharing this. In fact, to take this along, when I said, parent, many times it happens, there is convenience sake for succession planning, you always nominate someone, right? Now, a very, very simple thing where the NRI son buys house property outside India. We are taking an example of a mother being a second holder for the sake of convenience. Full cost is paid by son. Mother is just a beneficial owner in case something happens. So it's a joint hold, like we have in India, husband, wife buying the property and husband being the one who is generally, or the wife being the one, and the other name is just for the sake of convenience. In such cases, when you report, first of all, whether you have to report. Second, if you report, whether have you seen in the past some practical that they question that what is the source of you being a beneficial owner of this? you are, in fact, in such cases, it might happen that the person is not liable to file return. Let me be very clear. And, it doesn't even have assets to, ever in their life to buy such kind of property. So, Kartik, can you just tell me that what implications can have of non-reporting and even reporting the adverse ones, if there are?
Sure, Hardik. No, so so basically, if we see fourth proviso to 139.1, it says if a person is holds as a beneficial owner or otherwise any asset located outside India, like then the filing of return kicks in, even if you otherwise don't have any income in India, which is taxable in India. So it says holds as a beneficial owner or otherwise would include a legal owner as well, and therefore, even if you don't have income, you are liable to file return. Once you pass through this, you go to Rule 12. Rule 12 says if you are holder of foreign asset, then again you are required to file ITR2. Once you get into ITR2, you read instructions. It clearly says a beneficial owner and a legal owner both are required to report foreign assets in the schedule, in FA schedule. So mother in the present case, being a legal owner, even though only for a convenience purposes, should be reporting the asset in her foreign asset schedule in her tax return, irrespective of whether she has income, she does not have income, she is liable to file return and should be reporting as a legal owner. The second question which you actually asked was that she might get a notice as to inquiring the source of funds from where she has actually acquired the asset. Now, the reporting requirement also matches that if any information flows from the overseas country in terms of the holders of the property, the mother's name is also going to come. So effectively, if you report it, it will match. There are nuances in terms of how much percentage to report. Do you really know? Is it 1%, 0%, 50%? In case of doubt, report the entire amount of the property because that is what is going to flow from overseas. Correct. In case of source, we've been receiving such notices even for domestic acquisition of properties, correct, where the source has been asked for, and we are responding it. I think it's now responding just like a tick of a button to say that it's already included in some other assessee's asset, and we provide a PAN. I am hoping that something similar comes for the notices which are initiated under the foreign asset schedule as well. I don't think it is coming as of now because it's a long notice which a assessee reporting foreign asset gets. So they have to give a detailed explanation in writing as of now. But it will be great if for such cases if they come up with a direct response kind of a thing like they have done for a local thing.
Now, I add on is the difficulty becomes if this asset is being sold by NRI son, he takes the resources in his account, and from next year he is not the owner, so mom stops reporting in India. Now, notice can come that whether you sold this property, why or not disclose the capital gains, in your return of income.
I think this is a classic case, Hardik, where, as I told earlier also, that the balance sheet and schedule FA do not match. Don't even attempt to match it. So the mother in her own balance sheet, she is not going to show this asset because she has not contributed the funds to it. But as well as schedule FA is concerned, better to disclose it because tomorrow the query is going to come. And if it comes, then meaning if you do not disclose, then there is a risk of a high penalty.
Now what happens in case of course, the answer should be same, where there is a nomination is a foreign person's life insurance policy. Now here, in fact, let me tell you, of course, there it was a joint owner. Here I am a nominee. There is a right which might come to me. And in fact, in such cases, I've even seen, they are just being in a nominee case only if suppose there's a key man insurance, or if it goes to the company, then technically you are not the one. Only if something happens and the money flows to you. Now, how to report this, where to report this, is something a very dicey issue.
Correct. No, so I think nomination per se may not be required to be reported, because that will probably nomination will kick in only in case of death of the person. But if the person is a beneficiary, if an Indian resident is a beneficiary to the policy, then I have actually had a practical case where I have received a notice in case where husband was paying the premium to a life insurance policy and wife was the beneficiary to it. I got a notice. We replied saying that husband has disclosed the asset, the premium amounts paid in the foreign asset schedule of his return. We gave a copy of the return, and luckily the case was closed. The officer understood that husband has reported it. If there is one reporting which has happened, so it's okay if wife has not reported. We also put in an argument to say that wife, though, is a beneficiary, but she has no right in the policy until and unless husband is alive, because otherwise the maturity proceeds will go to the husband. It was a case of an investment come life insurance policy, which the husband has already reported in the return. So as a practical case, yes, we had received a notice, and on giving clarifications, it was cleared out. But if at all pre-hand that you are a beneficiary to a life insurance policy on a conservative basis, it is good if you report, then you will not get such notices and you will not have to respond. But as practically we've seen that if you respond saying that the husband has already disclosed, then there is no issue at all.
Now,
Hardik, sorry, just one point I want to add here. I think in terms of insurance contract, if you see the language in table A4, where it talks about foreign cash value insurance contract. Now it talks about a cash value insurance contract. So I think one important aspect one needs to consider is not all types of life insurance would be covered. Right. So, the common misconception is that all types of, life insurance is possibly covered. And I think maybe, one can, and these are, if you see table, and maybe, if you see table A1 to A4, there, I think a lot of it is coming, the terms that are used are similar to those used in FATCA. And, so while FATCA is only for, reporting by financial institutions, I think if one can look at guidance from there, what do these terms mean? Because, there's a lot of confusion in what are these, what is depository, etc., which we may cover later. But there, I think if you see, rule 114F, for FATCA, there, I think if you see the definition of cash value insurance contract, they specifically exclude, an insurance, which is, an amount payable under insurance contract, which is solely for the purpose of death. So a normal insurance contract would not be covered. What they want to cover is sort of, these investment products, which are sort of, guised as sort of insurance policies. So
money back or annuity or something like that.
Correct.
Where there is
not your nominal, not your normal life insurance policy. Possibly that.
I think that's very
right time, Hardik, to put in one word that in discussing all this, there will be several FEMA issues which we are not going into.
Absolutely.
So,
in fact, we can have another 1 day full seminar on how the interfaces of FEMA. In fact, let me give one example which we might cover in detail. When you said that a person becoming a non-resident. Now, generally, when you are going for self-employment outside India, opening a bank account, opening a company outside India, generally people try to become a non-resident and then open a company. Otherwise, you have to do all ODI stuff. Now, if that person unfortunately, he goes in November. Now, he is a tax resident for that financial year, right? He has spent more than 183 days. He has opened a company in January. Now, whether he has to disclose that in his FA schedule.
So I think the finance minister has listened to you, and therefore they are now told to disclose only till the December end.
So if it does in December, then what is your? So what I'm trying to say, of course, it is Jan to December. The point is, if you go and do the intricacies between different acts, it can be a never-ending issue.
Yes.
But yes, I think rightly show on this life insurance policy. Now, I think the new attractive is the gift city. Kartik, I think, I don't know how well it has picked up and how many people is impacted, but yeah, there are a lot of things in buzz, in media and everything. Now, let's see that if someone has made investments in gift city, whether that has to be disclosed in FA, because for all practical purposes, the way it has been marketed, it's a foreign jurisdiction. You're allowed, it's under FEMA, you can send under LRS. So what is your views on that?
No, so from a FEMA perspective, though, as we say, it is on par with an overseas jurisdiction, and therefore you do all the FEMA compliances as if it's an outbound investment. But from an income tax perspective, it is pretty much a territory within India, and therefore it is not any asset located in GIFT City will not be a foreign asset, and therefore you don't need to disclose investments in GIFT City in foreign asset schedule. But if it is shares of a company, you might have to report it under unlisted share schedule, which is a separate schedule altogether.
Great. Now, after at least just going with this, quick questions on the basics, the very important question which we should address right now: what if you have not disclosed? What if you have missed? Can you do updated return if you have missed even the revised return guidelines? Because updated return can only have if there is a demand, right? Or you are payable any tax. You can't go for just reporting thing. So just practical, your views on the same and what are the consequences for the same.
Yeah, so I try to spend about 5-7 minutes on this question and try to cover all possible nuances which are coming out of the sections. And if I miss any, please feel free to ask more questions on this, specific questions on this, no problem. So the whole consequences gamut, as far as penalties are concerned, comes from Section 42 and 43 of the Black Money Act. I think these are sections not within the Income Tax Act, though the reporting requirement comes from 139 read with Rule 2, 12 read with the Foreign Asset Schedule within the ITR form, which is all part of the Income Tax Act and rules. The penalties are prescribed under Section 42 and 43 of Income Tax Act of Black Money Act. 42 says if you are required to make a disclosure in the tax return of foreign assets, located outside India, or foreign income, and if you have not filed a return, then there is a penalty of 10 lakhs. There is a exemption for up to 5 lakhs of bank balance, which Rutvik already discussed. And there is a similar Section 43, which says if you filed a return and not disclosed foreign assets within foreign assets and incomes in that tax return, then there is again a 10 lakh rupees penalty with a similar exclusion for bank accounts up to a balance of 5 lakhs. Now, it is very important to note here that the section says you have to report it within the tax return. It doesn't specifically say foreign asset schedule. Correct? Despite this, everybody has received a notice, whoever has not reported in foreign asset schedule. In fact, I have got a practical life case where there is a company who has filed ODI, disclosed with RBI, filed APRs over the years. It's part of their annual report, which is filed with ROC. It's disclosed in the related party schedule as an investment in a subsidiary. It's part of the balance sheet. That same balance sheet is attached with the tax audit report as a attachment to the tax audit report. It's disclosed everywhere, but in the foreign asset schedule, and that person has still received a notice. Notice has traveled through assessing officer to CIT appeal cases out pending right now at ITAT level, and therefore because of this kind of a penal provisions, the person has to travel to ITAT level. I hope we have more such judgments at ITAT level like Leena Gandhi Tiwari and others. Correct. And they travel through to the High Court and we get a finality on what do for Section 42 and 43 of BMA really apply to. Correct. And these cases, if they are closed at the AO level or AO level itself after giving appropriate disclosures, that it's not it's disclosed elsewhere in the return, and therefore you should not levy penalty. But the thing as it stays now, the practical experience has been that even if you've disclosed it everywhere except for foreign asset schedule, even if there could be a case that a foreign house property is disclosed in the house property schedule, or you've sold it it's there in the capital gains schedule, and you've not disclosed it in the foreign asset schedule, still you are receiving notices. It travels through to assessing officer and through then to CIT appeals. And after that, you ultimately probably you will get, like Leena Gandhi Tiwari, you will get a relaxation at the ITAT level, but you will have to travel through that pain with a couple of authorities and incur that cost of litigation. Correct. Another important point. Sorry, please go ahead.
No, very unfortunate. In fact, it would be great if you can cover that little part which you said. People are asking questions on that also. If you can cover here. That, what if you have reported at one part of the FA schedule or in the assets and liability schedule, and you have not put it in another because it is getting covered in everywhere, right? So
that's what I'm saying. So section 42, 43 and 43 are very clear that you have to report it somewhere in the tax return. It doesn't specifically say FA schedule. And therefore, very technically, section 42, 43 penalties are not applicable if it is reported elsewhere in the return, like you said, asset liability schedule or anywhere else in the return. Correct. However, the officers at lower level are not buying this argument. They are levying the penalties. They are pushing it to CIT appeal. CIT appeal also, in our practical experience, has been pushing it to IT80. And at IT80, you should definitely, because Leena Gandhi Tiwari is very clear that an officer has to. There is one more point there. So there is an argument available to the department there to say that the provisions of 42 and 43 of BMA are little differently worded as compared to the penalty provisions under Income Tax Act, which Income Tax Act normally says that you should not levy penalty if there is a reasonable cause of failure to disclose. Similar language is not present in the Black Money Act 42-43 of the Act. However, it still says the officer may levy penalty. May levy penalty still means a discretion. And Leena Gandhi Tiwari, IT80 clearly says that the discretion available to the officer has to be exercised very judicially. And in cases, genuine cases where you've actually disclosed it elsewhere, correct, there you cannot actually levy the penalty and such a harsh penalty of 10 lakhs. So it's actually good if this penalty is reduced to a nominal one, then everybody will get a relaxation, or the principles of Leena Gandhi Tiwari, if they are actually followed at the AO level itself, there will be very great relief to the assessees. But the way the law stands today, the way the practical experience stands today, a person has to travel all the way to the IT80 to go through that pain of litigation at 2 levels to actually get the finality.
I think a couple of points here which I can add here is that what Kartik mentioned is very important. Also, on a practical experience, what is happening is that the officers are saying that their discretion, meaning even though they have discretion, they are not exercising it. See, that is where the practical experience comes out. Is that, well, Kartik clearly mentioned that it's may levy a penalty, but the true experience has been that the officers are saying that no, they cannot take any chances as far as foreign assets is concerned. If you are not disclosing in Schedule FA, they are themselves admitting that you please go to tribunal and you may win the case, but here at least I will raise the penalty. So it is becoming in practice an automatic penalty. And the second part is that then there is no discretion on the amount. See, even if tomorrow you say that, okay, fine, you levy, but if then officer is left with the discretion to levy a penalty on somebody who has disclosed, as Kartik gave that example, where everywhere apart from Schedule FA they have disclosed, I am sure the officer, if he would levy a correct discretion, he would levy a nominal amount and leave it. But because they don't have a choice, they are saying that no, it is either 0 or 10 lakhs straight away, and there is nothing in between, which is creating to this sorry state of affairs where we have got honest citizens who have disclosed everything, paid tax on it, sent through RBI channels, who would send, otherwise why would they come through, proper channels? Even after doing all that, these are the people who are coming to tribunal. So I think that's a side state of affairs, but that's the reality. That's the reality of today.
So what we should do now, if someone has missed, I think that is the last thing. What should we do?
Sorry, Hardik, just one more additional point on the earlier question. There is also a prosecution provision under section 50 of the BMA, correct, which talks about rigorous imprisonment of offered for a term which shall not be less than 6 months, but which may extend up to 7 years. But that is only in case of willful omission, correct, of non-disclosure of foreign asset. And this prosecution provision is also there for non-disclosure of foreign asset in the return. It's not for undisclosed foreign asset, which otherwise has a much harsher consequence.
Also, I think we can add here that surprisingly, PMLA also has got amendments which are leading to some serious consequences. We hope to see that the judgment gets reversed, but there's a recent decision of the tribunal under PMLA where they have kind of clarified that a non-disclosure of foreign asset has straight away led to prosecution under PMLA and seizure of equivalent assets. So while we are talking about disclosure of foreign, non-disclosure being something which may be very finally leading to only a financial penalty, one has to be very careful that it can lead to a seizure of assets of equivalent value within India. The decision is of, I think, Offset India Solutions Private Limited and others. Correct. Yeah, it's there reported in Taxman and it's by Safema Appellate Tribunal. So I think people have to be very careful now because it's not just under the Black Money Act penalty. It is not just under Income Tax Act, but you're straight away going to PMLA if the chain of events is leading to that. In this case, obviously, seems to be a clear evasion of tax, but my point is that the trigger was non-disclosure of foreign assets.
Yeah, in fact, one step ahead, this decision clearly, if you read through the decision and the facts, it clearly says that all authorities are exchanging information with each other, because they started with the 132 search in case of income tax, which led to FA schedule non-disclosure, and which then led to passing on the information to Enforcement Directorate for under PMLA.
Yeah.
So yeah, these authorities are actually exchanging information with each other. One additional point was about incorrect disclosure, which I wanted to cover in the consequences. And there again, there are a lot of judgments under Income Tax Act itself under 271(1)(c) of what incorrect disclosures, furnishing of incorrect particulars mean. And so even section 43 of BMA talks about furnishing of incorrect particulars of foreign asset. And there merely an omission or merely a different a mistake in terms of furnishing the particulars should not be regarded as furnishing of inaccurate particulars. If furnishing of inaccurate particulars has a real clear meaning, and one may refer to the Lipschroff's judgment, which is very detailed in terms of income tax provisions, and similar analogy should be drawn while doing the assessments under section 42 and 43 of PMA.
And just to add, I think, the one part is, you have disclosed, not disclosed in Schedule FA and disclosed in, say, Schedule AL or in bank account unlisted shares. Another aspect is within Schedule FA, again, that if you see the terms again, they're again very confusing. So whether it is table A1, A2, A3, A4, or B, where do you put it? And it could possibly happen that, the information that is received may be under A1 and you may have disclosed it under A2 or A3. That I think I don't think that should be considered as inaccurate particulars, because you have still disclosed it. I mean, it is not inaccurate. You have disclosed the entire this thing to the extent possible, and it's a view, because again, there's no, given the fact that there's no guidance, etc., on what these terms mean. I think you have a stronger case at least there to argue.
Correct.
So I think thanks, but the last thing, I'm sorry to pressing on this. What should we do it now? And especially, let me tell you, the questions are where there are students who have opened a bank account when they were studying outside India for their expenses and for their stipends, and now they are in India. That account is dormant. One fine day they are cleaning the cupboards and they get, oh, I had a bank account, I have now closed it. And so how you do a corrective action?
Yeah, so only a gambler, I think, would take this call of not disclosing it. Once you know it, obviously you have to disclose it. That you are owning a foreign asset, you obviously have to disclose it. And in fact, more so, because if you are disclosing it without receiving a notice from the tax department, there are good chances that you will be able to claim with the higher authorities to say that in the past it was a genuine mistake of not disclosing and there was no willful attempt to not disclose. If you disclose after not knowing, then probably that argument also goes away for the earlier preceding years.
Also, there is a clear disconnect between probably the intent of the CBDT, because what we have understood is that the data which is coming from to CBDT and then they are analyzing it, they are focusing on data which is coming in the CRS of FATCA. Then the CBDT has also designed the form in such a way that they are saying tables A1 to A4 are probably trying to match with that data. Now, their objective is that you, as Mahesh correctly pointed out, that as long as you're disclosing in some or the other table of Schedule FA, it should be good. Primarily, what we have understood is that even if you're not reported an asset, once you report it, it's good enough because you have finally in one of the years at least reported it. But the practical experience which is coming out is that they are issuing notices for each of the years and they are raising penalty also on each of the years. So if you're not reported one bank account for 4 years, then all 4 years they are raising penalties of 10 lakh rupees each, which seems to be something which is highly unreasonable. But that's the fact of the matter today. And the law, unfortunately, does not help that, because it does not say about a foreign asset which is disclosed. You look at it qua every assessment year, and that is where you are getting trapped. So
I think with the time which we have, I will move ahead right on this, because this is something which was very important. And Mahesh, if you can, I will ask you some quick questions, and some of them are already answered by Kartik and Rutvik and you. If we can pass by them, where FA schedule are to be disclosed in FA or AL. I think if it is there, you have to disclose both places.
Absolutely.
Where do bank accounts needs to be disclosed? Are they depository accounts? if you can throw some light.
So again, coming back to one of my earlier comments, that what is depository A1, A2, A3, A4, if you see, and if you see actually when Schedule FA started, 10 years ago, at that time it used to be, table A used to be overseas bank accounts, table B used to be financial interest in any entity, and then B, C, D was pretty much almost the same. Obviously within the tables there are a lot of changes, but now table A has been broken up and multiple to A1 to A4. So now these terms, if you see, they are very confusing terms. What is depository? What is custodial? What is, because a depository, is it NSDL? Is it depository participant? I mean, what are these sort of accounts? And there possibly, I think, guidance there would be, look at where your, because these are the terms which are coming from the FATCA CRS requirements. And there you have your income tax rules, which have provided what is depository account, what is custodial account, what is equity debt interest in a financial entity, etc. And the department also has come out with a guidance note on FATCA CRS. I think that is also very important. I think maybe important for professionals like us to look at those. While there are very complicated things for and specifically for financial institutions, I think it does give specific guidance on what is the department view, what are these accounts that are there. And in the guidance note, etc., if you see, or even in the income tax rules, your rule 114F, where the definitions of depository accounts are there. Depository accounts are basically your bank accounts, your commercial checking, savings account, or time deposit account, which are there. So to answer your question, yes, bank accounts would be considered as depository accounts under table A1.
Okay. What do you mean by other capital assets? Anything which you don't find from A to, and you put everything else, other capital asset. What are they trying to, because if you see, they have different headings, different columns. So what basically one should cover in other capital assets?
Yeah. So other capital assets is more sort of a catch-all provision to cover, capital assets which are basically not covered in A1 to A4 or table B, C, D, or table B and C, sorry. Because again, and if you see the instructions to the return filing form, they specifically also exclude, assets which are used as stock in trade or as business assets. So those assets are definitely not covered, but any other assets. So, so for example, and, there's an issue of, your rights, your ESOP rights, etc. Till they are exercised, whether, if you take a position that they need to be disclosed, then possibly they should be coming. And I think we have a case study on that. So that will definitely get covered. But typically that may cover, where you have a right to exercise your ESOP, where they are vested in your favor. And those would come as any other capital asset. Or, possibly even maybe your virtual digital asset. So those are assets which are not really covered in any, they are neither depository, custodial, financial equity interest in or insurance contracts, either the financial interest, and nor immovable property. So those are typical
advances given to others, right?
Yeah, even loans and advances, possibly, there are certain decisions which are held that loans given are capital assets. So there also loans and advances that are given, could come under other capital assets there.
I'm just going to take one term of what you said and we'll ask the views of all three of you. There are some questions on that. What do you mean and how do you report VDA, cryptocurrencies? Let's have some views on that. But that is something I think which has been discussed today also in media. And how do you report that? How do you report that? Where do you report that? You just purchased, or when you had purchased when you were non-resident and now you've become resident. How do you come to that?
No, this will lead to counter questions, Hardik, because you are the expert now. You have to tell us that whether it is an asset or not, whether it is located, where is it exactly located? Can you answer those two? Then I will tell you where it has to be done.
No, so I think I understand, of course, but I think I am a moderator today. So touch wood, I'm on a, but the point is, I think this is something which has been also asked by the participants in the Q&A box. How to tackle this?
I think, I'll just add here is that one of the panels where we had one senior tax official, and when these VDA amendments had come in, he himself also remarked that, even we are not aware where the location or situs of this asset is. So I think, frankly speaking, there is no clarity on those aspects, whether it is an asset or not. Now, finally, department is saying that let's consider it as a virtual digital asset and move forward. The whole idea under the tax law has been that they want to tax the income on the VDA. Now, under Schedule FA, whether it has to be reported or not, I would feel that it's very important that as far as you are holding it. So now again, we go back to that first, kind of principles where we say that we are trying to match with the data that will be received from abroad. Today, it is, these institutions are under so much pressure of reporting that most of these institutions which are holding these cryptocurrencies or dealing in cryptocurrencies are mandated by the country in which they are housed to report to their at least local governments about how many cryptocurrencies they are holding, the KYC details and all those. So good countries are all after it. In fact, in India also, we know they have gone into and they have brought it under the PMLA net also, and they have to report and they have to get the KYC detail. So this reporting is definitely happening. Point is whether cross-border exchange of information is happening on this or not, for which a continuous effort is going on a global scale. And in fact, it is our country which has been, kind of very, very taking a very, very proactive position on it and saying that no, this is outside the financial system and therefore you need to get them and make them report. And therefore a global kind of talk is going on around it. Certain amendments have also already been mooted for the common reporting standard. And to my understanding, if not today, definitely tomorrow, these VDAs are going to be reported. So now whether they are going to get that information or not, we must not wait for that. I would feel that a safe position would be to disclose it as long as you are aware that it is housed in a wallet which is held by a foreign company. Now, a lot of people have, shifted their cryptocurrencies because exchanges have gone bust and wallets have gone bust, and a lot of things have happened over the past couple of years. So I think the conscious decision which the taxpayer needs to take is that better at least disclose it. Tomorrow, if there's a query, they are not faced with a 10 lakh rupees penalty on it. And especially if they are sending money through LRS to invest into such VDAs, you are very clearly saying that, yes, I am purchasing some kind of a cryptocurrency outside of this country. So therefore, I would suggest that in those kind of cases, one must take a proactive stand and disclose it. I don't see any harm in why they should not. Obviously, we are not talking about evaders and those who are trying to hide their black money in VDAs. We are not talking about those people. So I think finally it moves down to the issue of information which is going to come, if not today, tomorrow, later. We must be careful of the fact that BMA acts as if that the day when the officer comes to its notice, he will say that, yes, this is a day, this is the year when I will issue a notice in the BMA. You don't want to face those queries at that time. So I would feel that that should be the safest way, but I'll still, Kartik and Mahesh can put their views also. So.
No, I completely agree with what Rutvik says, that, I think, better to disclose it rather than, face penal consequences, especially, for a taxpayer who wants to, comply. Definitely, I think, I don't think I have anything else to add to what Rutvik has possibly said here.
And I would, Kartik, you have some,
Yeah. So just to add, I think presently these wallets and exchanges, overseas wallets and exchanges, are not qualifying as financial institutions, and therefore the reporting is not coming. And that's why this work at OECD level was going on, and there is an amendment, and there is a whole crypto asset reporting framework which OECD has come up with in late 22. Correct? And the effort there also seems to be to now include these kind of exchanges and wallets to be qualified as a financial institution and therefore report this under the CRS. So there was a G20 article which Rutvik had shared with us, which said that probably the reporting will actually start from late 27 onwards. But whenever it comes, probably officers will have a right to ask for data for past years as well, to check as to why you have not reported and all those things. So it is better to report, and especially in cases where you have actually made a remittance from India under LRS or under LRS, then the Indian banks itself would have the data, and which can easily go to the tax department. So therefore, definitely 100% you should actually report.
Absolutely.
Also, Hardik, just to add here again that point which I referred to earlier, that clients come back saying that, oh, we don't have the data, it was housed in that online wallet. Now that wallet has gone bust, we don't have. So that is where it has to be extra careful that the series of transactions, because especially in the computation of income in India, they are ignoring total losses which are done. So at the end of the day, each transaction will have to be done. They switch from one cryptocurrency to the third to the fourth. By the time the first one has gone, cryptocurrency has gone dead. It's no longer there only. So my whole point I'm trying to make is that we have had cases where the client himself is not aware that what has actually happened, and they are not able to then trace documents. So it becomes very important that each and every transactional documents are maintained for these kind of transactions.
I think thanks for that. And Mahesh, I would like to ask, this is something, and there are some questions on that also. Where and how to disclose the foreign retirement benefit accounts in Schedule FA, and the mismatch which normally happens, that in some cases the tax is only on the when it is a withdrawal in that thing. There is another question: what if it is not taxable under DTAA? Social Security benefits received from USA, whether needs to be disclosed in Schedule FA, where needs to be disclosed, whether receipts needs to be disclosed, income taxable needs to be disclosed. I think this is something you can cover in a quick 2
Yeah, sure. I'll try and cover it quickly. So the point is, there could be two possible tables which could apply here. One is a custodial account or an equity and debt instrument in a financial entity. Because if you see what is a custodial account, again going back to guidance note and rule, income tax rules, there it talks about where you're holding an entity which is holding the assets in your name. So effectively like a broker account or where or anywhere where the assets are held in your name. Typically those are the assets which would get those accounts would be covered as custodial accounts in table A2. Or you have your table A3, which again talks about equity and debt interest. Now there, if you see the guidance note and the income tax rules, it talks about equity and debt interest in a financial entity, which typically talks about all your collective investment schemes, your mutual funds, etc. So so it will be table A2 or A3 is where one would disclose your foreign retirement accounts, depending on what is the nature of that retirement account, whether they are holding the investments, other investments in your name, or is it a sort of a collective vehicle where the investments are held on a collective basis. Now the second part is, if you're looking at table A1 to A4, if you look at the tables and you compare it with table B onwards, table B onwards talks about income, whereas table A1 to A4 talks about your gross receipts, gross amount credited, gross interest credited. It doesn't talk about your income per se. So and again, table B, etc. If you see onwards, it is trying to link it to the schedule where the income is being taxed and offered in the return. Whereas table A1 to A4 does not have that sort of criteria that is required to be met. So there, I think, again, if it is an income or a receipt which is not taxable, even then you need to disclose that because it is a gross amount that has been received. But typically, we believe that amount will not be linked to your income, because unlike table B onwards, which is specifically linked to talking about income, that should not create an issue even if you do disclose that in table A1 to A4 there.
Okay, just a follow-up on this. This is for everything. What exchange rate should one adopt for calculating the cost and the peak value? Any official shows and website for the same? This is very, very common.
Yeah, and I think that issue equally applies even to your normal income,
Right.
because it is the income tax rules. Your rule 115 talks about TT buying rate as per SBI and on different dates depending on the nature of income. Similarly, even for for Schedule FA, if you see the instruction kit to the income tax return, it again talks about your TT buying rate as per SBI on specific dates. So if it is on closing, then the closing date, or if it is peak balance, again it's on the peak balance date. So on those specific dates is when you need to show your exchange rate. Now the challenge that can arise there, especially for exchange rate, is not so much in A1 to A4, because again A1 to A4 does not refer to income, but table B onwards, because table B onwards you're talking about income offered to tax in your income tax return. Now there, the question there is, while, if you're converting it, and if you see the timing, so if you see the instruction kit, the timing for which the time on which the exchange rate is to be converted, the date on which it is to be converted may not necessarily match with your rule 115 rule, where your income is to be computed. So there, again, there would be a mismatch. But I believe there, at least, when one is talking about income derived from the asset as a whole, you can consider your income that is in accordance with the instruction kit, your TT buying rate as per the date on which the opening balance or the peak balance or the closing date of the year of the accounting period, which is 31st December. But the income offered, income offered under the schedule, and when you need to give the specific schedule, there definitely I think you should consider the exchange rate as on the which is in accordance with what you have offered the income to under rule 115, because otherwise, and of course there would be a mismatch. But in any case, there is going to be a mismatch because one is talking about a calendar year and one, your income is being offered in a financial year. So that we believe that mismatch is something that is explainable. But at least, one should not happen. There should not be a scenario where I am showing a higher income that is offered to tax because of I'm using a different exchange rate. Vis-a-vis when I go to the actual schedules, I have offered the income that is lower because of the actual exchange rate that I have used under Rule 115. So I think I think one needs to be mindful of.
Just one view of what happens, Kartik, I will just ask a follow-up to this. What happens if someone, because see, this is even a layman and a novice would ask, what if I don't get that SBI TT bike? Where they're asking peak balance, they're asking closing balance. What if I take a XC.com or any online site, whatever many times people do. What are the replications? Sometimes I feel these are the small things, but these are some things which might trigger something, in future. Any views on the same?
Yeah, sorry. So you asked Kartik, but I think I can look at, in my view, at least, possibly, yes. I think SBI rate, while the rules do talk about SBI rate, we all know it is practically not possible to get SBI rates, on a backdated, this thing, at least archives. And therefore, possibly an RBI rate, can be considered, but, I think again, important that you at least document it. Because practically, yes, it is going to be difficult to get an SBI buying rate, especially when you have multiple transactions during the year.
Yeah, Kartik, you were adding something.
No, I agree with what Mahesh said here. On the earlier point, just one note that there will be a mismatch in case of table B onwards in terms of income reported in one column versus income chargeable to tax that you report in column 10, 11, 12. And that is going to be there for multiple reasons. One could be because of the 31st December versus 31st March. Other could be because of the exchange rate. Third could be because house property you are offering 70% in the house property schedule versus 100% is shown in the gross income. There could be indexation in case of capital gains. There could be a possibility that capital gains is in respect of 10 assets together in the capital gain schedule versus it could be all 10 assets are reported separately in the FA schedule. So I don't think one needs to be bothered about it, but it's very important to have a reconciliation of both the schedules ready so that at the time of assessment you can immediately give it, because during assessment you don't get much time to sit down and reconcile and open the old record. So reconciliation of the tax schedule with the FA schedule, keep it at the time of filing the return itself. That's one note which I thought I'll make it.
I'll just add one small point here is that what forex rates do not come out in the format of the FA schedule. So what we as a practical tip one can take is that it's better to maintain the record of the date on which the forex rate has been considered. So let us take a peak balance issue. Now peak balance is, for example, on the 1st of May of 2022. Now you are going to, what is the date of that peak balance? Then in foreign currency, what that is going to come out in the FA schedule. But what is the forex rate as on that date may not come out in the foreign asset schedule which you are reporting. So what we have seen is a lot of people do it or directly in the tax software, but they don't maintain the record that, okay, this is a particular forex rate and this is the source of that forex rate. Today you might have taken, from FBIL. Tomorrow you may take an SBI TT rate, whatever it may be. It's better to keep a record of that because the queries will come only 2 or 3 years hence. And that time to hunt for that, okay, what was the rate, why we took that rate, is going to be a cumbersome affair. Also because you will be reporting certain assets on an annual basis. Every year that same asset on a cost or historical cost basis you will be reporting. It's always better to maintain that track of what was the rate you have taken and what date was it of that rate and what was the source for that rate. That should ideally be maintained somewhere as a record.
Great. I think thanks for that. And I think this was covered by Mahesh, largely that of course it has to be for calendar year, right? A to A1 to A4, and I think let's move on to the case studies. Because this is, I think, where the crux lies, and there are a lot of queries, let me tell you, on ESOPs, RSUs, and I think we need to cover that case study too. So, without wasting any time, if Mahesh, can you just quickly run through this case study?
Yeah, absolutely. I think this case study, is a little more simpler. I think maybe I can just quickly run through it, and then maybe we can have more time for the other case studies. So quickly, so this case study covers your overseas brokerage account. So typically, you have overseas brokerage account in a US with a US broker. Now there would be
I think if you can just, sorry to interrupt here. Hardik, can you go to the next slide? We have taken out the issues. So maybe.
Maybe we can go to the discuss. Yeah. So the question here is, what is the brokerage account, whether it should be disclosed in table A1 as a depository account or table A2. Again, I think, broadly discussed, if you look at the, income tax rules for FATCA, I think custodial account would typically get covered in table A2. Depository account typically is your bank accounts. Therefore, custodial account, so your brokerage account would be disclosed in table A2. The second question is on underlying securities, whether, so the question is, if you've disclosed the, brokerage account in table A2, do I need to disclose the underlying securities in the respective schedule? That is whether A3, table B or table D. There, I think, so long as you have disclosed the entire value of the investments, aggregated them in the brokerage account, even if you have not disclosed individual assets, possibly I think you may be it may you may be able to defend that, but there could be
No, please finish.
Yeah, but there could be a situation, like we talked about mutual funds being, in table A3. Now, what could happen is there could be multiple reportings also, because, for example, if I'm holding mutual fund units through a broker, so now broker would report to the Indian authorities through the automatic exchange of information. The mutual fund also would report to the tax authorities, and there would be a double reporting there. So there again, one needs to be able to justify, and therefore, on a conservative basis, you may consider reporting, even the underlying assets. But yes, even if you do not, I think there is a fair chance or a good argument to say that, listen, so long as I've considered the aggregate value of the investments in the brokerage account itself, I need not disclose the individual investments on their own. And if so, sorry, go ahead.
Only qualitative difference here is that when I'm using the brokerage account myself to invest into, say, certain scripts and shares, right? So then I might as well disclose the underlying. But if, say, for example, I have given, $50,000 for the PMS account, and that PMS account is handling it. So what is happening is that financial institution is reporting an aggregate value. So I think from that qualitative difference, one must bear in mind that if they are using a brokerage account to invest directly into shares of foreign companies, then the reporting may probably come through for each individual script. So that is where probably some difference can be kept in mind.
So I think I will just add on this, because just to summarize, mutual funds is something which needs to be disclosed as a custodial account. That is what Mahesh is trying to.
A3, in table A3.
In A3. Now, when you say Rutvik, just to add, because see what will happen, you have to queue the peak balance. Now let's assume if that person has traded in 100 scripts, okay, and if there is a peak balance, right, because it says at any time during the year. Right. And if in India you have this NSDL report where you can easily get for your demat account, what was the peak balance, and you don't have to go for the 100 scripts which you're thinking. So don't you think that a practical stand of till I have disclosed my assets, I have disclosed that account number, which brokerage account, or where I can have a peak balance at any point of time. Otherwise, it becomes very cumbersome process to search for all that 100 scripts which have been. It might not be through a PMS. I agree with you. If it is through a PMS or mutual fund, life becomes very easy, right? But what if you yourself have done through a brokerage account? Then what happens?
No, I would probably put it this way, that if you yourself have purchased those shares, then the peak balance, I agree. Meaning there are cases where we are doing 300 to 400 line items of scripts which are purchased personally, because people would have bought when they are non-residents. Today they are. But the problem is that the peak balance is being reported. See, at the end of the day, that information is going to come. Now, if it is cumbersome, so be it. But I would not take that chance to tomorrow face a 10 lakh rupees penalty, which may only get deleted at the tribunal level. So I would probably take a chance to say that, yes, if that be so, at least it's a 1 year exercise, which then every year you may have to report that peak balance, you may have to update it. But then that's a given fact. I don't think that one can run away from it, especially because if you notice, even in foreign countries, in fact, your Indian holdings, these non-residents are required to report at peak balance. So you actually have to hunt. We have had cases where NRIs, filing their returns in the US have to report the peak balance of the Indian securities, and you also have to hunt on Money Control or some other such website for what was the highest rate in the stock exchange on, for that particular script. So that same goes, because that reporting happens there also. I don't see why it should not happen in India. Now, I agree fully that yes, 100 scripts, it takes too much of a time to do it. But I don't see per se that between April to July, you may not get that much time to invest into and finding it. So I would probably not take that risk, especially if I am myself investing into those 100 scripts and tomorrow that detail may come to the department saying that yes, this was a peak balance. Now, at the end of the day, finally, it is all justifiable to say that fine, I have reported the asset. The peak balance idea is somewhere for them to actually find out that what was the highest value of the transaction which happened. And generally that happens only for an account. So when I have a custodial account, when I have a depository account, their whole idea is that if a person will try to reduce the balance as on the year end or the reporting date, so that the person will always try to say that my assets held abroad are only so much. To catch that is where the peak balance matters. Otherwise, to have a high script value on a stock exchange for that particular year, how does it matter? It changes nothing. So from that objective, that is quite justifiable. So I go with you that yes, if it's quite cumbersome, then justification can be given and say that it's meant for an account and not for a particular script.
Yeah, so we rightly said table A3 we are saying is applicable only in case of CIS or table A itself is applicable only in case of depository or custodial accounts or CISs or insurance. And therefore, the peak balance requirement again does not come in table B or D. Correct. And therefore, putting the shares under table B, then the peak balance requirement will
doesn't come in only. So that's something.
Okay. Now, I'm since we are short on time, I'm not going to go through each and everything. I will ask some few burning issues and the questions which are already been there. So something related to that. What happens to unlisted shares?
So in our view, I think shares, have to be disclosed in table B. Table A3, I mean, there is a confusion of whether table A3 will apply or table B or table D. In terms of A3, I think again, going back to the guidance note, I think it talks about collective, it refers to collective investment schemes. Just reading the table, one may think that A3 applies because it is equity or debt interest. But if one sees the objective behind it, if one sees FATCA, etc., the conclusion that we have come to is that A3 is more for mutual fund or collective investment schemes, and financial interest in an entity is where one would disclose your shares. And therefore, your shares would need to be disclosed in A3. And again, then, coming to what Kartik mentioned, that if there are shares, then again, you don't have to give a peak balance, in that because of the value of the shares, because A3 does not, table B does not ask you to disclose the peak balance there.
Yeah, I think that's all, because otherwise what happens many times, these unlisted startups go for valuation, raise funds. And, we have invested at suppose $10 million and they rate at $3 billion. And then you take that as a peak value, that would be something which will be catching eye of the, department. So I think,
just to add here, before we move to the next question, there is this unlisted equity share schedule, which I think Kartik earlier referred to.
Absolutely.
That will have to be filled in. There is no exemption that it is only for domestic shares.
Agreed.
So there will be some hidden places where foreign assets have to be reported.
If you earning more than 50 lakhs, it would be thrice. It would be foreign asset, unlisted shares, and even assets and liabilities schedule. So you have to report in all three of them. And that is what the life is in compliance. But I think that's what we did. Now, I think what I would say, let's keep this part. If we can do to ESOPs, because many questions are there on ESOPs and RSUs. Kartik, can you please run through this? And I think I will, if there are something which you don't cover in next 5-10 minutes,
you will catch it.
Questions. No. I'll try to cover each and every stage of ESOP. Don't worry, Hardik. Right. So I think the example that we have taken here is an employee of an Indian company which has a foreign parent is receiving ESOPs, is part of the ESOP scheme of the foreign entity, of the Indian entity, under which it gets the ESOPs or shares of the foreign entity. Right. Now, what happens at each stage of what reporting requirements and what happens at each stage of the ESOP scheme? Right. So let's take an example of an employee who just joins an employment. And this is a very rare scenario. And say, for example, it says that his offer letter says that he'll be eligible to get a grant of an option only after, say, 1 year or 2 years of employment, which means we are talking about a grant period. Very rarely does this kind of a situation arise. But during this period, he doesn't have anything. He doesn't have any contingent right also. It's just that he hope that he'll continue with the employment and he'll be part of the scheme and he will get a grant at a future date. No disclosure requirements in our view during this period. Say he enters the scheme, he gets the grant of the options, but there is a vesting period under which he has to either satisfy the time vesting conditions or a performance vesting conditions. During this period, again, he still has a hope that he will either complete that time vesting conditions or performance vesting conditions or a combination of both. And therefore, according to in our view, again, you really don't need to make any reporting till the time in the vesting during the vesting period, till the time the options are actually vested. Once the options are vested, the employee gets a right, and therefore from that date onwards it is up to him to exercise that right or not, and therefore that right is a right in a capital asset to acquire a share in future, and from that date onwards he should start reporting the assets in the foreign asset schedule. And because it's an option till that date, it's still not a share, therefore it will be reported under table D of FA schedule. And once you make the exercise, you do the exercise, post that you have to start actually reporting that in table B, which will be a listed or an unlisted share depending upon the type of asset. I think Mahesh and Rutvik, any other points to add? I try to keep it crisp to the point.
I think just is there any difference between RSUs or ESOPs that you might want to highlight?
Yeah, so there are multiple types of ESOP schemes. As long as we are aware of the concepts that I just spoke about, at what stage what happens. In case of RSUs, again, during the vesting period, you will not report anything. In case of RSUs, you may not have an option to convert it into shares, and therefore on the date of vesting, you will start reporting the right that you have depending upon when you exercise it, whether you exercise it or not. But the reporting under table B will never come, because the moment you exercise it, you will get the cash in your account, which will be the differential price. Similar thing happens in case of a SAR or a phantom, where again, during vesting period, you will not report anything. Once the vesting gets completed and you exercise it, you will get money directly. So the concept is clear. As long as you are holding a right, as long as you are not holding you are holding only a hope, don't report it, it's okay. But once you are holding a right to acquire a future shares at a future date, and you have that clear right, and you have to decide when to exercise or not, you start reporting it in table D. And once it gets converted into a share of the company, start reporting in table B.
I think a lot of queries are coming from the fact that maybe tomorrow they may not exercise it. But I would feel that does not mean that they do not disclose it in the foreign asset schedule. Tomorrow, yes, they may lapse, but that doesn't mean that you do not disclose it, even if it may be contingent or not.
In case of a stock purchase scheme, I think, again, during vesting period, if at all there is nothing to be reported, as soon as the vesting is completed, exercise is made, you directly get the shares. There is no option kind of a thing there. And therefore, in case of an ESPS, you start reporting it directly in table B, as you will be allotted the shares.
Anything from Mahesh you want to add on this?
No, I think Kartik has covered it pretty
extensively. Time that is permitted to us.
Yeah, absolutely.
Yeah. So the point what I'm trying to say is now since we are already at 7:30, we have one more case study which we can cover. But what I will try to ask you some questions which is there in the Q&A box. Or we cover. Can we cover Rutu? Can we cover holding company structure in next 5-10 minutes? Is it?
Sure. Let me cover it in 1 minute. See, this is no, I understand there are several questions, and I believe so that we should answer them to the best capacity possible. So I think this is an idea where you have Mr. A and Mr. B owning an Indian company Exco, which has a subsidiary YCO, which has a subsidiary ZCO. The whole issue here we are talking about is that Mr. A and Mr. B are holding actually only an Indian asset. They are not even holding a foreign asset. Now, Exco is the company which is holding a foreign asset in YCO. So the whole requirement comes into play that whether Mr. A and Mr. B are supposed to disclose the foreign asset, because they are indirectly holding the foreign asset in YCO. Now, whether Exco is to report YCO or it also has to report ZCO. So this prima facie, when you look at it from a balance sheet perspective, you will say Mr. A and Mr. B don't have to disclose any foreign asset because they don't hold it. So the problem rests with the fact that yes, the reporting requirement or the disclosure of information which comes from abroad, it comes on the basis of that which is the ultimate beneficial owner. And in that sense, it comes out that, okay, person YCO and even ZCO for that matter will report that Mr. A and Mr. B are the eventual shareholders of ZCO. So whether you go in, cut through all the layers and report your holdings in ZCO also, one would say that no, my balance sheet does not include it. So definitely, and also all the more, even if I'm reporting XCO, it covers assets held in YCO, which covers assets held in ZCO. So in a sense, it has already been covered. We would not take that chance because foreign asset disclosure scheme, as we discussed again and again, that the point is that the reporting information comes from abroad. They are actually pinpointing that yes, Mr. A and Mr. B are the holders of foreign assets in ZCO. So our primary objective should be that yes, if you cut through the layers and report it, at what level should you stop? Should you stop at every, at the nth level? Because tomorrow there may be here just 2 layers. It may be say 20 layers. So prima facie objective is that you at least report to the first level of the foreign asset so that you are justified to say that yes, I have reported YCO. YCO's underlying assets I may not be reporting, but at least I have a justification to say that yes, I have reported YCO. This is the foreign asset which includes all the underlying assets under YCO. But not doing so may create an issue. And if you go to the next slide, I think so we have kept some kind of newspaper article which clearly said that they stated that yes, the tax officer is after all of them on indirect holdings. Now the problem is that tomorrow can you go and say that no, I was not supposed to disclose it because it's not part of my balance sheet? I don't see that will hold water, because the problem is that directly and indirectly held also are supposed to be covered. And therefore, one may cover it. And if you look at the beneficial owner definition, it says in respect of an asset means an individual who has provided directly or indirectly consideration for the asset, and where such asset is held for the immediate or future benefit, direct or indirect, of the individual providing the consideration or any other person. Now, prima facie, it targets the individual. So I would probably go to say that XCO will report only YCO as its own foreign asset, but A and B will report YCO. And then probably it will say directly or indirectly, if at the end of the day you are disclosing ZCO, do not be in that frame of mind that I am doing double disclosure. My net worth will probably show much larger than what my actual net worth is. Forget all that, because there is no totaling in Schedule FA. If you notice, there is no kind of total which they make and say that no, yes, this is the total foreign assets you're holding, and therefore you are now, we'll question you that how come you invested so much. No, that is not the case. Their questioning is for each asset. What is the source for these funds? Okay, for ZCO, the funds are from YCO. Okay, what is the source for YCO? Then that's XCO. What is the source for XCO? Then yeah, these are my tax-paid sources of money. So I think we have to take it from step by step, but at the same time, to save yourself from penal consequences, you may go ahead and report the underlying assets, because that is the objective of the department also.
Yeah, so a counter to it.
I'm sure my 2 co-authors will have a lot to add.
Yeah. So in fact, I will just add before they. So now, isn't this absurd? Because I know you are coming from back, but suppose there is a listed company which is reporting its 200 subsidiaries overseas, right? You can't have a 51% individual owner here. Everything is reported to SEBI, to everyone. He can't report 200 companies in his. I don't even know whether
no. I think that is where we may also have to draw some discretion. See, at the end of the day, what kind of reporting will happen? Your holding shares in Apple Inc. will not going to be reported in your name, Hardik. So I don't think we need to fear that, because I don't see that kind of a reporting is coming. But yes, unlisted equity shares where you are holding financial interest, I would not take that stand. In fact, recently PMLA has reduced the UBO definition from a holding of 25% to 10%. Now that's not just India which has done it. It has actually happened quite on stage-wise basis. It is happening on a global way, because what the people are seeing is that 25% holding is too high a holding for marking a UBO. At the end of the day, there is no such threshold which is built into the disclosure requirements as far as beneficial owner definition is concerned under the Act. As you can notice, there is no such threshold given in the definition. There may be under CRS. Under CRS, there is certain reporting obligations and they have certain thresholds. But do you want to depend on that, or do you want to say that no, I am holding financial interest in an unlisted entity which is holding another unlisted entity? I would probably feel that is something which you have full control on. You can see that what you are holding, and therefore you may better as well report.
So you mean to say, okay, then let me put it this way. If I am holding 51% in a listed entity which has 200 unlisted entities, then your view is that it might not be required in such.
At the end of the day, the reporting will come. So now I am only saying that the first level of the foreign asset definitely must be reported. Beyond that, if you're holding 200 other subsidiaries, then yes, meaning apart from what questioning you will face with how you're holding 200 subsidiaries.
No, so it's a subsidies of a listed company, unlisted subsidies for different projects overseas.
So you have to be justifying that why you're not done it, because there are 200 companies, it's a listed company, you're already disclosing that listed company. The first level foreign asset is definitely very important. So in this A and B's case, you cannot take a ground that no, it is only Indian assets which I hold and I'll not report it on.
No, so I'll just add, I think very technically, if obviously in this facts of the present case, A and B are not legal owners of YCO or ZCO, any foreign asset.
Yeah.
Right. Further, even if you look at the beneficial owner definition, which was there in the other slide, correct, it says it has to be an individual who has directly or indirectly provided a consideration. So strictly speaking, A and B can't be said to have directly or indirectly provided a consideration for buying shares of YCO or ZCO. It might be an indirect holding, but you can't say they have indirectly provided a consideration. It means the phrase means something else. And therefore, very strictly speaking, if you see A and B are neither beneficial owners or legal owners as per the definition. So very legal, and this view has been approved by Jaipur Tribunal also in Krishna Das Agarwal's case. Exact similar fact pattern where a bank account was not reported of a foreign entity by the individuals holding the entity. And they have said, no, bank account of a foreign entity, the individuals don't need to report unless they are a signatory to the bank account. So there is a legal guidance. Very technically, reporting may not be required, but if you have control over the entity, you have access to the data of the subsidiaries. At least try and report the shares of the shares of the underlying company. If it's very difficult to get into it, like you gave an example, I'm holding 1% in a listed company or 0.5% in a listed company, and it has subsidiaries. You definitely have sufficient justification to say that no, I may not have reported it.
So I think, and just to add, sorry, so just a couple of quick this thing. So just to add, I think to what Rutvik and Kartik have said, and possibly slightly diverging there is possibly, I mean, legally, I think again, you are not required to report. So, if one talks about penal consequences, yes, information may come under FATCA CRS, that is one. But, where is the legal requirement for me to report it? Because, again, Kartik took us through the definition of beneficial owner. Now, the definition of beneficial owner is the same in the Income Tax Act, if you look at Explanation 4 to Section 139, as well as, even the instructions to the income tax return. So, legally, I was never required to report it. So, where's the question of reporting? Of course, there would be reporting that would come, the tax authorities would get that information. But there, I think there's a good case there to argue that, again, in taking benefit of the Jaipur Tribunal that Kartik alluded to. So there, obviously, there, I think, because otherwise, if one takes a legal view that no, one has to report it, just because one does not have that information or one does not have control over that information, does not, make sure, does that make it that, one should not report that, for example, listed companies or, mutual funds where I know for a fact that they're investing only in FANG stocks. So where do you draw the line? And that's where I believe that at least, using the same arguments, that legally, I think you're at least on a good footing to say that, in such a situation, you need not report.
Agreed. I think what my view could be put up as a conservative view, but at the same time, it's also where notices are coming. So one has to be careful. In fact, very recently also several companies actually have been sent notices that why they have not reported their underlying assets. So, it's something which at the end of the day, from slide what I'm saying, that look at it from what information is going to come and then put up justification about why you are not probably disclosing something, rather than having a justification to say why you have not disclosed it.
Thanks. I think thanks. We have tried to even touch. I've asked you questions which are kind of taking some of the Q&A into account. Of course, there are plethora of questions which have been asked. We have tried to address them. Just one last thing that was asked. RSUs, when you explained, it was to be reported in which schedule, Kartik?
RSUs will go in table D, right, Mahesh?
Table D, right? Whether it is RSU or it is ESOPs or any kind of, so it would be under other capital asset.
Except where you have an incentive payment itself, See, everything is notional, but you are at the end of the day getting something akin to a bonus. So in that kind of a case, but otherwise RSUs, to my understanding, will be
also restricted stock units. So till the time you are holding the units after vesting, yes, you will report it under table D. I think in some rare situations, again, RSUs can be converted to shares. So if you convert it into shares, very rare, then post that you start reporting under table B.
Great. I think I know we have already run out of time. I have tried to cover some of the questions, or I would say combining them and asking you the same. Thanks, Rutvik. Thanks, Kartik. Thanks, Mahesh. I think we might need another session on the interplay between FEMA, Income Tax Act, BMA,
Okay.
and you
Let's
can
see,
we just
almost 100 questions. Wow.
yeah, that's a
Yeah.
it
So I
might
think
take
one way
another
we can
hour to
always say
listen to
that
them each one.
all of them can refer to the book too.
I think one last important point I think I can add is that if you've not forgotten to report it in your this current return on 31st July, you still have time till 31st December to revise the return and report it. Report the foreign asset. There is no penalty for that. Hardik had referred about updated return. The BMA penalty provisions have not been changed after the introduction of 138.8A, where updated return is allowed. But BMA still says that as long as you're reporting under 139.1, 4 or 5, which is original return, late return, and the revised return, then you are not liable to penalty. So yeah, I just
Great.
add that.
I think that's very helpful. That was also a couple of questions. Thanks. I think I will hand over to Deepak Bhai.